All right, everyone, let's get focused. We're going to do a rapid fire revision of income from other sources to make sure you're absolutely ready for your exams. Let's nail this. All right, section 1, the residuary head. Let's lay the foundation. What exactly is this head of income? Look, just think of it as the catch-all bucket. Any income that you can't classify under salary, house property, PGBP, or capital gains, it lands right here. It's the tax department's final net. So, to wrap up this first point, IFOs is your final destination for any income that doesn't fit elsewhere. Now, why does this matter in the exam? Simple. The examiner will throw you a curveball, some weird income source, and you'll need to know where to put it. If it doesn't belong in the other four heads, its home is right here. Okay, on to section 2. This is a major scoring area, folks. What's actually taxable under IFOS? You absolutely have to know this list. Okay, look at this list. These are your heavy hitters, the ones that show up on exams all the time. I want you to pay extra close attention to two things: dividend income and casual income. You know, lotteries, betting, that stuff. They have very special rules. And don't sleep on family pension or interest on compensation either. They have some specific deductions we'll talk about. All right, quick recap. IFOs covers a whole range of things, from dividends to your lottery winnings. This is a major scoring area. Do not skip it. The examiner absolutely loves to ask questions from here. So first things first, you have to know what the law even considers property for this section. It's a very specific, closed list. You see it on screen. Land, buildings, shares, jewelry, all that stuff. But honestly, the most important thing for you to remember for the exam is what is not on this list. The classic example, a motor car. Gifting a car is not taxable under this section. That's a trick question waiting to happen, so burn that into your memory. Okay, let's apply this with a quick example. Mr. A gets a few things from a friend. First up, cash, 75,000 rupees. Is it taxable? Yes. Why? Because it's over the 50,000 rupee limit. The whole amount becomes taxable. Next, he gets bullion worth 60,000. Same logic. It's property and it's over the limit, so the full 60,000 is taxed. And finally, a plot of land received for free. The stamp duty value is 5 lakh. So guess what? The entire 5 lakh is taxed as income. Simple as that. All right, now for a key exception. This is a big one. What happens if Mr. A is actually a dealer in shares, and he buys some shares for a really good price, way below market value? Well, since those shares are his stock in trade, basically the stuff he sells for a living, Section 5622X does not apply here. That benefit he gets will be taxed under his business income, not as a gift. Making that distinction is absolutely crucial for full marks. Okay, let's do a quick rapid fire on another examiner's favorite, the HUF. Scenario 1. A Carta's niece gives a gift to the HUF. Taxable or not? It's taxable. Why? Because the definition of relative for an HUF is only its members. The niece is not a member. Got it? Now, scenario 2. A member gives a gift to their own HUF. Taxable? No way. That's a gift from a relative, so it's perfectly exempt.
Next trap. A friend gifts you a car worth 5,25,000. Is it taxable? No. Why not? Because a car is not in the definition of property. Now listen carefully. This is where most students make mistakes. You get jewelry worth 45,000 and shares worth 10,000. Individually, they're both under the 50,000 limit. But that's not how it works. You have to check the aggregate value. Add them up. That's 55,000. Since the total is over the limit, the entire 55,000 is taxable. Don't forget to aggregate.
Okay, quick recap on gifts. The rule is simple. Any money or specified property you get from a non-relative, for free or for too little, is taxable if its value is over 50,000 bucks. Why does this matter in the exam? Because they are going to test you on 3 things: the definition of property, the definition of relative, especially for an HUF, and that stock and trade exception. Nail these and you got easy marks. This is where things get really interesting. The stamp duty value trap. We're talking about sections 43CA and 50C, and this is where we see a tax impact on both the buyer and the seller. So you really need to focus here. So here's the classic scenario you'll see in a question. Someone sells a property for 90 lakh, but the government's value, the stamp duty value, is way higher at 150 lakh. When you see a huge gap like this, alarm bells should be ringing. This difference is going to have tax consequences for sure. And here it is. Listen carefully. This is where almost everyone messes up. The question will mention something like this: An advance was paid, but it was paid by a cross check. It was not an account paid check. This tiny detail, crossed versus account payee, changes everything about how you solve the problem. So what's the big deal about that check? Here's the consequence. Because the payment wasn't made through a prescribed banking channel, like an account payee check, the seller loses a huge advantage. They can't use the stamp duty value from the date of the agreement. They are stuck using the higher value from the date of the actual transfer. In our case, that means we have to use the 150 lakh figure, not the lower. Okay, so what happens to the seller, Mr. Hari? This depends entirely on what that property is to him. Case 1, he's a property dealer. For him, the building is stock in trade, so we use Section 43CA, and the profit is taxed as business income. Case 2, he's just an investor, maybe a share broker. The building is a capital asset, so we use Section 50C, and the profit is taxed as capital gains. The amount of profit is the same, but the head of income and the tax rules are different. You have to get this right. And we're not done. What about the buyer, Mr. Rajesh? He got a great deal, right? Paid 90 lakh for something worth 150 lakh. The taxman sees that 60 lakh difference as a benefit he received. And where does that get taxed? Right back where we started, Section 5622X, as income from other sources. See how it all connects? The seller is taxed and the buyer is taxed. So to recap property deals, if the stamp duty value is more than 110% of the actual sale price, you ignore the sale price and use the stamp duty value. And remember, the mode of advance payment, that account paycheck detail, is critical. Why does this matter in the exam? This is the ultimate integrated question. It tests 43CA, 50C, and 562X all in one go. Right. Section 3, deductions. Listen up because this is where easy marks are won and lost. Examiners love to test the common confusion points right here, so let's make sure you're not one of the people who gets confused. This table is your friend. You need to memorize these limits. No excuses. Especially family pension, 1/3 or 15,000, whichever is less, and the interest on compensation, which is a straight 50% deduction. These are gift marks, people. Don't leave them on the table. But, and this is a big but, listen carefully. Knowing what you can't deduct is just as important as knowing what you can. The examiner is absolutely going to try and trick you with expenses that sound reasonable, but are a definite no-no. And here they are, the classic traps. The most important one, the one I see students mess up every single year, is this. No deductions from casual income. I'm going to say it again. You win the lottery, you cannot deduct the cost of the ticket. Do not fall for that trap. And of course, any personal expense is always out. Okay, everyone, eyes and ears on me. Pay close attention. Listen carefully because this is where a lot of students lose marks. Section 4, the deemed dividend trap. We're talking Section 222E. This is a classic exam problem. Here's your 4-step checklist. Is it a closely held company? Is it a loan or advance? Is it paid to a shareholder with at least 10%? And does the company have accumulated profits? If you tick yes to all 4, boom, you have a deemed dividend. But, and this is the key, it's only a dividend up to the amount of the accumulated profits. Anything over that is just a loan.
This example makes it crystal clear. Look at scenario 1. It's a public company. Stop right there. The rule doesn't apply. Zero deemed dividend. Now, scenario 2. It's a private company. Shareholder has 28%. It's a loan. All conditions met. The loan is for 5 lakhs, but the accumulated profits are only 4 lakhs. So what's the deemed dividend? 4 lakhs. The other 1 lakh, that's just a regular loan.
So, to recap this trap, a loan from a private company to a major shareholder is often a dividend in disguise, but capped at the accumulated profits. Why does this matter so much on your exam? Because this isn't a 1-mark question. This is a high-value adjustment. Nailing this can seriously boost your score on a big problem.
You've probably been taught the money you get from your life insurance policy is always tax-free, right? I mean, Section 1010D makes it exempt. Simple. But what if I told you that for your exams, that's just not the full story anymore?
Let's get right into it. The rules have officially changed, and you can bet this is a hot topic for ICAI. For any life insurance policy issued on or after April 1st, 2023, that old, always exempt idea is totally out the window. A huge amendment has kicked in, and if you don't get a handle on it, you're pretty much walking straight into a classic exam trap.
So, instead of me just reading out the law to you, let's do this the way ICAI will. We're going to start with a problem. a classic exam-style question that's literally designed to catch anyone who hasn't been paying close attention.
All right, have a good look at this. This is your exam question. You've got 4 different life insurance policies, X, A, B, and C. Now pay close attention to those dates of issue and, more importantly, the annual premiums. But here's the little note at the bottom that changes everything. The C has already claimed an exemption for policy X in the previous financial year. Tuck that little detail away. It's going to be important.
So here it is, the big question. In the current year, policies A, B, and C are all maturing. Which of these can the assessee claim as exempt? Take a second. Are you thinking maybe A and B? Their premiums add up to 4.5 lakhs, so that seems to fit, right? Or maybe you can't claim any of them. This is exactly, and I mean exactly, the kind of confusing spot where marks just disappear in the exam hall. Let's break down the rule that's going to solve this entire puzzle, the new and improved Section 1010D.
So, first things first, what are we even talking about? The law has a name for these new policies, eligible LIPs, and the definition is super simple but absolutely critical. It's any life insurance policy, just not a ULIP, that was issued on or after that magic date, April 1st, 2023. That date is the starting point for everything we're about to discuss.
And this number right here, this is what changes the entire game. 5 lakh rupees. This is the new annual premium threshold. You need to burn this number into your memory because every single calculation we do from this point on is going to revolve around it.
So for any of these new eligible LIPs to be tax-free, there are 2 golden rules you gotta check. First is the old classic, the premium check. The annual premium can't be more than 10% of the sum assured. You've probably seen that a million times. But rule number 2, that's the big one. That's the new threshold check. It says the aggregate annual premium you pay in any year for all your eligible policies put together cannot go over 5 lakh rupees.
Okay, that seems simple enough if you just have one policy. But you know ICAI, they love to test you on what happens when you have multiple policies. So what happens when you've got a bunch of them and their total premium just blows past that 5 lakh limit? Let's see.
This slide lays it out perfectly. On the left, if the total annual premium of all your eligible policies is 5 lakhs or less, hey, congratulations. Everything's exempt as long as you pass that 10% test. But on the right, this is where it gets interesting. If the total premium goes over 5 lakhs, the law gives you a choice. And this is so important. The SSE, that's you or your client, gets to pick and choose which policies to claim. Let me be absolutely clear about this. The power is with the assessee. You can pick any combination of policies you want, as long as their combined annual premium stays under or at that 5 lakh limit. So, what's the smart move? Obviously, you're going to choose the combination that gives you the highest tax-free maturity amount. It's a strategic decision. But hold on, we're not done. We've covered the basics, but now we get to the real ICAI twist. This is the part that separates the students who get full marks from everyone else. I call it the chain reaction rule, and it is the key to solving the problem we started with.
Now, to get this twist, you have to know this new term, EEE LIPs. It stands for Earlier Exempt Eligible LIPs. Yeah, it's a bit of a mouthful, I know, but the idea is actually simple. It's any of those eligible LIPs we talked about, one issued after April 1, 2023, that you have already claimed as tax-free in a past year.
So here's the question that traps almost everyone. Let's say a policy matured last year. You claimed it as exempt, the money's in the bank, it's a done deal. So for this year's calculation of that 5 lakh limit, you can just forget about it, right? It's in the past. It shouldn't matter now. No, absolutely not. And listen, if you write down one thing from this whole explainer, make it this. You cannot ignore it. The annual premium of those EELPs from past years must be included when you're checking the 5 lakh limit for the policies maturing in the current year. It creates this chain reaction that carries over from year to year.
Let's apply this look-back rule to our problem. Remember policy X? Last year, it matured. Its premium was 2.5 lakhs. You claimed it exempt, so bam, it's now an EEE LIP. So this year, when policies A, B, and C mature, you don't start counting from 0. Nope. You have to look back and start your count with that 2.5 lakh premium from policy X already on the scoreboard.
Okay, let's put it all together and solve this thing for good. Step 1, identify our EEE LIP, that's policy X, with its premium of 2.5 lakhs. Step 2, check our options for this year, but always remember to add them to X's premium. So if we add policy A, we get 4.5 lakhs. That's inside the limit, that's an option. Now if we add policy B instead, we get exactly 5 lakhs. That's also allowed. Step 3, choose the best option. To maximize our benefit, we look at the maturity values. Claiming B gets us 38 lakhs tax-free, which is way better than A's 24 lakhs. So step 4, our conclusion. Only policy B can be claimed as exempt, and that means both policy A and policy C are now fully taxable. See how that works?
See, knowing the right answer is half the battle, but presenting it perfectly in the exam to get those full marks, that's the other half. So let's quickly build a blueprint for exactly how you should structure your answer.
Your answer needs a clear, logical flow. Just follow these 5 steps and you'll be golden. First, always quote the provision. Start your answer by name-dropping Section 1010. Second, explain the new rule. You have to mention that 5 lakh limit. Third, analyze the facts. This is where you show your calculation, and please don't forget to include the EEE LIP premium. Fourth, state the choice. You have to explicitly say that the assessee can choose the most beneficial option. And finally, number 5, conclude. Give a crystal clear final statement on what's exempt and what's taxable.
And here you go, a perfect example of a concluding line. You can literally adapt this exact phrasing for your answers. It's clean, it references the section, and it shows the examiner you know not just what's exempt, but also exactly how the taxable part is treated by putting it under income from other sources.
Awesome. Now before we finish up, here are a few quick pro tips. These are those little details that ICAI just loves to hide in MCQs or one-mark questions, so listen up. First, what about GST on the premium? Simple. You ignore it completely. The 5 lakh limit is on the premium amount before GST. Second, this entire thing does not apply to term life insurance. Term policies are always exempt, and you do not include their premium in your 5 lakh calculation. Third, we said it before, but it's so important, if a policy is taxable, that income goes under income from other sources. And finally, how do you calculate the actual taxable income? It's just the maturity money you got minus the total premiums you paid over the years for that policy.
So what's the one big idea from all of this? It's simple. The 5 lakh limit has a memory. It doesn't just reset to 0 every year. You must always look back and account for the premiums of any earlier exempt eligible LIPs. That right there is the #1 trap. So now you've mastered when a policy becomes taxable.
Okay, we're on the home stretch. Section 5, special rates and the final tax. This is a major scoring area, so don't tune out now. You can do all the computation right, but if you apply the wrong tax rate, you lose the marks. This is how you finish strong. First special rate. Burn this number into your brain. 30%. This is for all your casual income. Lotteries, gambling, game shows. It's a flat rate. No basic exemption, no deductions, just a flat 30% tax. Next up, an even scarier number, 60%. This is the tax on unexplained income. Unexplained cash, investments, you name it. This is a penalty tax. The government does not want you to have this kind of income, and the tax rate shows it. Now, for both of those special rates, the 30% and the 60%, there are 3 golden rules, and they are strict. Rule 1, no deductions. Rule 2, you can't use your basic exemption limit against them. And Rule 3, you can't set off any other losses against this income. You pay tax on the full gross amount. So what about everything else? All the other income under this head, like your interest income or family pension. That's the easy part. You just add it to your other regular income and it gets taxed at your normal slab rates. Simple. Okay, let's recap the tax calculation. Your exam strategy should be this. First, identify and pull out any income that has a special tax rate. Calculate the tax on that separately. Then take all the other income from this head, add it to your total, and apply your normal slab rates. Why is this the only way to do it? Because applying the wrong tax rate is a massive fundamental error. Always check for those special incomes first. All right, you now have the rules, you know the concepts. But the real question is, can you apply them under pressure? The only way to find out is to practice. So go, solve some problems, focus on these key areas, and you'll be in great shape. Best of luck.